At one point, Elon Musk watched roughly $200 billion vanish from his net worth, the largest personal wealth drop in history. Most people would panic, sell everything, and disappear. He didn't. He treated it as part of the game he chose to play. Before we talk about losing $200 billion, we need to understand what that actually means. Elon Musk's wealth is not a pile of cash. It is mostly shares in a few companies, especially Tesla and SpaceX. When those share prices go up, his net worth explodes. When they fall, his net worth crashes, even if he does not sell a single share. During the peak of the Tesla mania, investors priced Tesla not as a normal car company, but as a world-changing tech platform. The stock went on a huge run. At one point, Tesla's market cap passed $1 trillion. On paper, Elon Musk became the richest person in history, worth well over $300 billion. Then the mood changed. Interest rates started rising, and risky tech stocks sold off. Investors began to question how fast Tesla could keep growing and how realistic the most optimistic stories were. At the same time, Musk bought Twitter, which many people saw as a distraction and a financial drain. Confidence slipped, and the stock price followed. Over the next year or so, Tesla's market value dropped massively from its peak. Because Musk's wealth is so concentrated in Tesla shares, his personal net worth fell by roughly $200 billion on paper. Headlines called it the biggest wealth drop ever recorded. But here is the key point. Nothing about that crash changed the basic fact that he still owned huge chunks of Tesla and SpaceX. The businesses were still there. The factories still existed. The rockets still flew. The loss was the market's changing opinion, not his skills suddenly disappearing. For most people, a big drop in their net worth is not just a number. It is a full-blown identity crisis. They see the line go down and think, I am failing. I am in danger. I need to pull back. Musk does not see it that way. From the start, he has treated his life like a series of high-conviction experiments. When he poured his PayPal money into Tesla and SpaceX, he already knew those bets could wipe him out on paper. The goal was not a smooth ride. The goal was to build things that almost no one else was willing to attempt. That same mindset applies to the $200 billion swing. In his world, volatility is not a bug. It is a feature of concentrated exposure to big ideas. If you own a massive chunk of a company that the market cannot decide how to value, your net worth will swing violently. To him, that is the price you pay for owning the upside instead of just watching it on the news. He also thinks in very long time frames. He's not asking, how do I look this quarter? But, will this company still be pushing the world forward in 10 or 20 years? In that context, even a historic drawdown is just turbulence on a long flight. Most people design their lives to avoid volatility. Musk designs his life to maximize meaningful upside and then builds a mindset that can survive the chaos that comes with it. Here's the mental model at the center of this story: the volatility rule. The volatility rule says that if you want outsized upside, you must accept outsized volatility. Not just in your bank account, but in your reputation, your emotions, and your sense of certainty about the future. Most people think in reverse. They quietly believe they want big upside with small downside. They want to win big without feeling big swings. That sounds nice, but it's not how real risk works. The world does not pay you extraordinary rewards for ordinary levels of discomfort. Musk accepts that. First, he treats volatility as a side effect, not a verdict. When Tesla's price falls, or his net worth chart looks like a cliff, he doesn't assume the mission is wrong. He checks the fundamentals. Are the factories still running? Are the cars getting better? Are rockets still launching? If yes, then the drop is volatility, not failure. Second, he separates signal from noise. Signal is product progress, cost curves, adoption, and technology. Noise is daily price moves, social media mood, and headlines about world record losses. He pays attention to the signal and learns to live with the noise. Third, he optimizes for survival more than comfort. Being emotionally comfortable every month is not the target. Keeping the companies alive long enough to realize their potential is. As long as he can survive the swing, financially and mentally, he's willing to let the line move violently. You might not like his choices, but the volatility rule is simple. If you demand a perfectly smooth ride, you're also choosing a permanently limited destination. It's easy to say accept volatility. It's harder to survive it. Musk doesn't just rely on willpower. He quietly structures his life so that huge swings are painful, but not fatal. First, his personal spending is tiny compared to his net worth. He's owned mansions, sure, but he's also talked about sleeping at factories, on friends' couches, and focusing most of his resources on the companies, not on a billionaire lifestyle. When your burn rate is low relative to what you own, you can ride out bigger storms. Second, he spreads his mission across multiple companies, not random investments. Tesla, SpaceX, XAI, Neuralink, and others all sit under one general mission: pushing technology and humanity forward. If one company struggles for a while, the overall mission still feels alive. That keeps him emotionally invested even when one line on the chart is ugly. Third, he stays close to the work. Musk spends time in factories, on launch pads, in engineering reviews. That daily contact with real progress makes it easier to ignore the noise of daily price moves. He can see with his own eyes whether things are getting better or worse. The lesson for you isn't to start 5 companies. It's this: design your finances, your lifestyle, and your work so that you can take meaningful risks without being wiped out by a bad year. We're taught to fear volatility. Big swings look dangerous. But there is another risk almost no one talks about: the risk of a life that's too smooth. The default path sounds safe. Go to college, get a stable job, take the promotion, buy the house, put money into diversified index funds, keep everything reasonable, predictable, and acceptable to everyone around you. On paper, that is low risk. No giant public failures, no brutal down months, no sleepless nights wondering if your company will survive. But underneath, the opportunity cost can be huge. When you design everything around stability, you also quietly design out most of the upside. You avoid the projects that could change your life because they might make your income bumpy. You avoid equity because it can go up and down. You avoid standing out because standing out can attract criticism. Your graph looks smooth, but flat. The uncomfortable truth is, if you never feel real volatility in your career, you might never have given yourself a real shot at extraordinary results. You probably don't want Elon-level chaos in your life, but you can still use a lighter version of his volatility rule. Start with your skills, not your stocks. Pick one field where you're willing to get uncomfortable and go deep. Coding, sales, design, operations, content, whatever fits you. Commit to becoming top 10 or 20%. That concentration of skill is your first real asymmetric bet. Next, take small but real risks around that skill. Maybe you join a younger company where you get equity instead of just salary. Maybe you start a product on nights and weekends. Maybe you launch a channel or newsletter that could eventually become a business. The downside is time, pride, and some money. The upside is a completely different life. Then, lower your survival number. Keep your fixed costs sane. The smaller your monthly must-have, the more volatility you can tolerate in income and opportunities. You buy yourself the ability to say yes to things that might not pay off right away. Finally, expect rough patches. A bad month, a failed launch, or a client leaving isn't proof you're on the wrong path. It's volatility. The question isn't how do I avoid it, but how do I stay in the game long enough for the upside to show up? Elon Musk's $200 billion loss is extreme, but it exposes a question you can't avoid. What size of swing are you willing to live with? If a temporary hit to status, income, or comfort scares you more than a lifetime of just fine, your choices shrink to match that fear. But if you can tolerate some chaos, you unlock different options, ownership instead of just a paycheck, paths that could change your future. Zoom out. 20 years. Would a few brutal dips matter if the curve of your life was 5 times higher? If you want more billionaire mental models turned into everyday moves, subscribe to the Billionaire Blueprint.